All right, let's dive into one of the biggest, most talked about deals of the year, that massive $12 billion share sale from Saudi Aramco. We're going to break down what's really going on behind those giant headlines.
I mean, it's the first question that pops into your head, right? Aramco is just this absolute cash-generating machine, so why on earth would you sell even a tiny piece of it? Answering that one question, well, that's the key to understanding a huge shift in global finance.
So let's start with the sheer scale here. $12 billion. This isn't just some small transaction, no way. This is a massive capital markets event that makes the entire financial world stop and pay attention. Okay, so what did $12 billion actually buy? It bought 1.55 billion shares in the company. But honestly, that number by itself doesn't tell you the whole story. You need a little more perspective to really get the strategy here. And here it is. This is the crucial detail. That massive $12 billion sale, it represents just 0.64% of the entire company. The Saudi state still holds almost all of it. So you see, this wasn't some desperate fire sale. Oh no, this was a very, very precise and calculated financial move. So this leads us to the next really important question. Who actually needed this cash? Was it Aramco, the company itself, or was it somebody else? Because the answer to that question changes everything. And you've got to make a key distinction here. Aramco, the company, is swimming in cash. It absolutely did not need to raise money for its operations. The seller here was the Saudi state, which happens to be the main shareholder. And their goal was simple: turn a tiny sliver of their shares into cold, hard, spendable cash. So let's be super clear. This wasn't a corporate fundraiser. Think of it more like a national-level liquidity event. The Saudi government was basically looking at its own balance sheet, pointing to one of its most valuable assets, and deciding to turn a small piece of it into cash it could use for other things. This entire deal, when you get right down to it, is a masterclass in a financial strategy that we're seeing more and more of. It's called capital recycling.
So what is capital recycling? It sounds fancy, but the idea is pretty simple. You take a mature, stable cash cow of an asset, in this case, Aramco. You sell a tiny, non-controlling piece of it to generate a huge pile of cash, and then, and this is the important part, you reinvest that cash into the next generation of high-growth industries. It's literally about turning today's stability into tomorrow's growth. You can really break this whole playbook down into 3 very clear steps. Step 1, sell a small slice of a crown jewel asset. Step 2, collect billions and billions in cash. And step 3, funnel that capital into strategic sectors that are going to power the future. Simple as that.
And where's that $12 billion going? It's being used to strengthen the firepower of Saudi Arabia's Public Investment Fund, the PIF. And that money is being aimed squarely at these huge growth areas. We're talking tech, the energy transition, tourism, all the key pillars of the country's ambitious plan to diversify its entire economy.
Okay, so that's the strategy for Saudi Arabia. But a deal this big doesn't happen in a vacuum. It sends some pretty powerful signals and creates ripple effects all over the world.
For one thing, the fact that this sale was so successful, even with all the economic uncertainty out there, proves there is a huge appetite from global investors for stable, really profitable companies, what people are calling high cash flow champions, especially in emerging markets.
You know, this isn't just a one-off thing. It's actually part of a much bigger trend we're seeing among governments and sovereign funds. They're getting really smart about monetizing small pieces of their biggest assets, recycling that capital into new strategic areas, and using their own public markets as these incredible tools for generating cash.
There's a quote from one analysis that just nails the strategy perfectly. It's all about retaining control of strategic assets while selectively monetizing liquidity to fund diversification. I mean, that's it in a nutshell. It's about getting the best of both worlds. You keep control of what's important, but you cash in little pieces to build the future.
And that really leaves us with this one big, fascinating question. We have just watched a nation turn a tiny fraction of its old-school wealth into a $12 billion war chest for the future. So you have to wonder, is this capital recycling model going to become the new playbook for how nations all over the world fund their own futures? It just might be.